right, welcome to Coffee with Markus. Wow, I'm super excited. Today's show will be amazing. So we will talk a little bit about what's happening in the markets, but this will only take us 2 minutes or so. And then we will talk about risk-free option strategies. I came across these risk-free option strategies and I thought, what? What is this? So I had to look into this. So we will talk about what it is. Is it really risk-free? And I'll show you how you can use them. And then we'll talk about my current trades. And then since you're here live, of course, we will can take as many questions as I can here. All right, so as you can see, super exciting. Let's get started. This show is about real money and real trades. I'll show you the trading strategies that I personally trade, the tools that I use to trade my own accounts, and we will talk about the right mindset of a trader. Now, talking about mindset, I'm going to show you how to create SRC profits. And SRC stands for systematic, repeatable, and consistent, because that is the key to long-term success in the markets. So, if you are sick of all the hype and empty promises, and you want to learn trading strategies that actually work, then click on like right now and let's get started. All right, let's get started and let's jump over and see of what the heck is happening in the markets. And here we see the S&P 500 and right now trading around the flatline mark after selling off yesterday because the Fed said, you know what? We will not only stop buying bonds, we will not only raise interest rates 3 times next year. No, we will also unwind our balance sheet. And this is what the markets did not like, especially yesterday. The NASDAQ was hit hard, recovering a little bit, slightly up. But if you look at the 5-minute chart of what happened here, we see that it looks kind of innocent that at first we went down and then we went up. But if we measure this move, which looks so innocent, then you will see that this is a 1.9% move. So almost a 2% swing this morning from, where are we right now? Like, the sky is still falling and, okay, I think we will be okay. So this is what's happening right now. Definitely some volatility. Now, all eyes are on the jobs report that is being released tomorrow morning. And this could shake the markets again. Now, as you can see, the NASDAQ has found some support right here. So touched support once, twice, and a third time. And thus far, support seems to hold here. Let me just remove this really quick and then also jump over to the S&P. And for the S&P, we take our good old friend, the 50-day moving average. And as you can see, the S&P 500 bouncing off the 50-day moving average right here. So super, super interesting of what is happening in the market. But what I want to talk about right now is even more fascinating. So we want to talk about risk-free option strategies. So you see, a few days ago, I heard about this risk-free option trading strategies. There was actually a post in our community here. Let me just show you this really quick. And this was about risk-free trades. And so this is where Kevin actually posted a few examples here and then say, hey, what do you guys think? And there was a lot of interest there. So this is why I thought, you know what, we need to look into these risk-free option strategies, because if they exist, this would be really, really awesome, right? So this is where let's take a look at this. So as I was researching these risk-free strategies, I came across a video from this good-looking guy. It's Chris, who has a channel called Project Finance. So Chris, much respect for your channel. You are doing an amazing job. I really enjoy watching your videos. So, and this is a video from December 15th, so a few weeks ago, where he explains how to create risk-free option positions. And I thought, okay, we got to look into this and we got to see what exactly is he doing there. And oh my gosh, this is where we probably should zoom out a little bit so that we can see of what's happening there. There we go. So risk-free option trading strategies, do they exist? Let me make this a little bit bigger and take a few notes here. So what is the idea? And this is where I looked into what Chris said and also what Kevin shared in our private community. And the idea is to buy a call on a stock that you believe will go up. So nothing special there. But then this is the idea: a few days or weeks later, sell a call with a higher strike price for a credit. And I thought, okay, That's quite interesting. So let's actually take a look at a few examples, because the result here is that when you're doing this and when you're selling the call with a higher strike price for a credit, this is the key here, that you have a risk-free trade and can lose. What? Risk-free trade and can't lose? Okay, so let's take a look at this. And so I studied the example from Chris from Project Option. Again, Chris, great channel. And so here is the example that he gives. So on September 23rd, Chris bought the 900 Tesla call expiring January 2023. And you might say, wait a minute, 900 Tesla call to December 23rd? Yeah, pay close attention. 2020, okay? So let's jump over to the charts and let's actually take a look at this. So I'm removing the 50-day moving average here because we don't need this for the example. And I'm bringing up Tesla as a chart. So right now we are on a daily chart. And since we need to go back to this example from Chris from September 23rd, 2020, we have to scroll back quite a lot until we see where did he actually enter the trade. And he entered the trade right here. So as you can see, this is when Tesla was trading at this point at 380. Okay, so Chris said that this is where he entered the trade and he bought a call with 850 days until expiration for $101.30. Now here is what he did then. A few weeks later on January 8th, Chris sold the 1500 Tesla call expiring January 2023 for what? $233. Okay, so let's take a look at this. Let's jump on the chart and then also see what happens. So as you can see, Tesla then, after going sideways for a while, did what Chris wanted it to do. It went up, 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 up. And right there, I mean, Chris timed it perfectly. And he said even in his video, got a little bit lucky here of selling the call right here. So let's actually do the math. And this is a screenshot from Chris' video. You can watch the video here. It's, again, Project Finance, how to create risk-free positions. So he paid $10,130 for the long 900 call, collected $23,300, and the result is $13,170. And now he said, well, I can lose. There's only potential to the upside. And I thought, okay, this is really cool. This is fascinating, right? So this is where one of our members in our private community, Kevin, actually said, okay, I did 2 trades according to these rules. And this is where I want to dissect these trades and basically tell you of what I think. So here is this is a real trade from Chris, and this is here a real trade from Kevin. So this is a more recent trade here, obviously. So on December 20th, 2021, so just a few weeks ago, Kevin bought 580 Apple calls expiring September 16th for $13.45. So he had to pay $6,725. Okay, let's jump on the chart. Let's take a look at Apple. Let's actually look at here, what happened recently. So you see, this is when Kevin bought this call, and he bought the 180 call when Apple was at around 170 here. And again, this is what you do on a stock that you assume is going up. And so what Kevin then did a few days later is on December 28th, Kevin sold 5 190 Apple calls expiring September 16th. And for this, he paid $7,200. So as you can, he received $7,200. So as you can see, this is where it resulted in a credit, right? And he said, actually, in his document, his assumptions, the net credit was $475. And if the stock goes above 119 between now and expiration, I will receive $5,000 more. Okay, so let's take a look at this. So he sold a few days later. So he didn't wait as long as Chris, who waited a few weeks. So Kevin sold it just a week later. And again, this is where here's his original document where he says, well, the net credit was this. And if the stock goes above 190, I receive 5,000 or more. So this is where I thought, okay, let's plug this into an option calculator and take a look at this trade. If this is a truly risk-free trade. And yes, It is. Look at this. So if Apple moves lower, and I hope that you can see it, so there's a break even at 180. So and if Apple stays at 180 or below between now and September 16th, this is when Kevin sold the puts, this is when he will just receive $475, but can lose, right? And in the best case scenario, this is where he said, well, you know what? If Apple keeps going higher, I can collect $5,000 additional dollars plus the $475 that he received as a credit. So $5,475. I mean, isn't that amazing? So let's dissect this trade because this looks just amazing. Now, so here's the deal. And this is where I asked Kevin if it is okay if I'm using his example here to show what you need to know. So first of all, the assumption, Kevin, that you have here is wrong. So you won't get $5,000 between now and expiration. You only get the $5,000 if the stock goes above 190 at expiration. Now, let me show you. If, for example, over the next few days, let's say in a month from now, so I'm going, as we're recording this, it's January 6th. So let's say we're going to February 6th, and if it now goes to, let's say, 190, you see, if it goes to 190, you're only getting around $3,000, right? So this is important to know because there's still some time value in there. So just keep this in mind. I mean, I'm not saying, well, this is why the trade does not work. But the assumption that you have here between now and expiration, now if the stock goes above 190 by expiration, and I mean, the expiration is 200 days from now or something like this, because you picked the September 16th. So this is quite a while. So just be aware of this, that it is only around 3,000. So this first assumption is wrong. You will get approximately 3,000 if the stock moves to 190. And as you can see here in this risk graph, of course, as the stock moves higher, you will make more money, right? So this is where it goes up to 5,388. And again, your maximum that you can get on this trade, that's what we saw here, is 5,475. But until expiration, not quite yet. Okay, so this is the first thing. Now, the other thing that I think is just worth considering is that you have theta, time decay, right? So for the 180 call, and I want to show it to you here, the time decay is 3 cents, 3.333 cents per day. Now, this is not a big deal because in your case, what you did is you waited only 8 days until, right, you could add this second leg here. So you only lost 24 cents. But you see, Chris actually was waiting 107 days. If you would have waited much, much longer, which I know you didn't, you would have paid $3.21 in time value. You would have lost this on the option that you had bought, right? So just keep this in mind. Keep this in mind. And so let's move to the third thing here. And the third is where it actually is not risk-free. In fact, there's actually more risk. And this is why I want to hand it over here for a moment to Chris, who in this video at the 10-minute mark is actually explaining it. So listen to Chris for just a few seconds because I think it's super important.
That started this trade off. So to create a risk-free call spread, you can't do it right out of the gates. You have to first take more risk than a traditional call spread because you first have to buy a call option, which is going to have more risk than buying a call spread since you're not going to be shorting that higher strike call right out of the gates. And therefore, you are going to pay a little bit more for just that one single call option as compared to buying a call spread.
All right. So I think this is important, right? So, I mean, and Chris, I think who introduced Kevin first to this here, it's actually more risk in the beginning. So be aware before you add the second leg here, there's actually more risk. But by the way, I know that this is a little bit more advanced concept. Is this helpful for you at all as we are going through this and talking about the myth of risk-free trades? And I'll show you here in a few moments of how you can use this because there is a good use for this particular strategy. But if this is helpful, do me a favor and click on like really quick as we are going through this. Okay, so in the beginning, we are taking on a little bit more risk. So since we are at risk, let's talk about the risk. So you see, you got to see you lose premium if the stock goes sideways. Now, in your case, you timed it perfectly, right? I mean, you bought Apple here, you bought the call here, and then a few days later, boom, it went up. That is fantastic. It had a really, really good move. But just keep in mind that there are some other examples where you might say, I'm overall bullish on the stock, but the stock at first is going sideways. In fact, this is where I want to go back to Chris's example here that he used, where in the beginning, when he was looking at Tesla, right? So you see right here, he actually bought the call, and for a while, Tesla didn't do anything. So this here is for 2 months. For 2 months, Tesla just went sideways. While doing this, you are actually losing every day, since you have the time decay that is kicking in, right? You lose the theta. And this is where it could be that your call option is worth less and less. So in the beginning, keep in mind what Chris said here. There is more risk. So the other thing just to consider is that you're capping the upside. You see, let's just take a look at this. If the stock goes 200 by March 6th with this strategy, so let's just say we are changing this to March 6th, which is 2 months from now. So 2 months from now, and we're back to Apple, right? So let's take a look at Apple. And we're taking a look here at the Apple chart. And maybe you say, you know what? I think that it is very likely that over the next 2 months, Apple actually goes to 200. What do you think? Is that reasonable? Could be, right? So if we take a look at this, with this particular strategy, if we are looking at 200, you would make around, what, $3,600, right? Which I think is not bad at all, because after all, it is risk-free. But here's the deal. Here's the deal. So let's actually see what happens if you would not have sold this call. If you just, see, initially you bought the 180 call. So let's see what happens if you just had the 180 call and everything the same. So all I'm doing here is I'm removing actually this, and I'm looking at 200. Do you see this? This means that if you had not sold the call and Apple goes over the next 2 months or 3 months or 4 months, anyhow, before September, because this is when you have actually, see, we can say, what if Apple goes by April to 200? This is when you could make $6,000 or $7,000 if it moves here rather quickly. And so I just wanted to show you, right? So if you're selling the 190 call, you're kind of capped. You make $3,600 if the stock goes up by to 200. If you only had the call, it went up to 7,500. Now, admit it, right? I mean, everything has pros and cons. This is where here you could still lose money, as you can see, if you just had that call. And so therefore, this is why we added it. This is why you sold it, to kind of lock in profits, to cap the upside and to lock in profits on the downside. So just keep this in mind, Kevin. So if you're super bullish on Apple, you are capping to the upside and you're probably leaving a lot of money here on the table. All right, last comment, and then we'll talk about how to use this trade and when to use this trade. So is this, what you did here, really better to lock in profit? So I'm going back to your example, right? So you did say you bought the call here, and then a few days later, let me just reset the chart. A few days later, you sold the other call to lock in profits, right? And this is where I'm taking this from your document, where you said, okay, you bought it for $6,725, and then you locked in the profits. But here's the deal. See, on December 28th, this call that you bought, instead of selling the 190 call, if you would have sold this call right away, it was worth, I looked it up, I have historical data here, it was worth $18.40. So if you would have just did this as a 1 week trade, and you bought the call here, and then you sold it here, and not locking yourself in until September. And again, yes, there's no buying power required, so all of this is good. It's basically a trade that can go on until September. But within 1 week, you could have made here $2,475. So this is why I'm just saying, does it make sense to sell that call here, or would it be better to just take $2,475 in a matter of a few days and be happy and try to do that again. Okay, so let's talk about this. When is this a good strategy and what is it for? Oh, I just had another example here. This also from Kevin, where he actually had a second trade that he did, right? And where he received a net credit. And so he gave me some numbers here. And on this one, actually, you could have also made $4,000 in profits if you just had sold this here. Anyhow, you get the idea. So let's talk about this. When does this strategy make sense? And surprisingly, I mean, Kevin, you said it, that it's probably best for a stock that is going up. But no, it's actually best when you expect the stock to stay in a range. And here's why. Here's why. So Chris is actually telling this idea 15 minutes into the video. So you can take a look at the video here. So at the 15-minute mark, he talks about trading in and out of the short option. And this is where it gets interesting, right? So the idea here is, as Apple goes higher, right? So right now, for example, you have sold the 190 call. Now it goes back down. So this means that right now you can probably buy back the 190 call for cheaper, and you can already pocket some money. Now, if then Apple goes up again, then you would sell the 190 call again, right? So you keep the 180 call, but now you play around with the short call. And this is what Chris here calls trading in and out in his video. I think this is what it is titled. Trading in and out of the short option. This is how you could collect additional premium. So in a nutshell, what is this good for? It is great if you think that Apple might stay here in this range and might not go above 190, because as it goes above 190, you are right now capping your profits compared to just a naked call here. And so this is where you could probably use this on Apple. You can probably use this on Tesla. So if you would have used it at Tesla while it was in this range, it might have worked. So the important thing here is, unfortunately, as much as we would like to have a risk-free strategy, there is no way to actually have a risk-free strategy. And in fact, in the beginning, you're taking on more risk than putting on the call spread right away. Is this helpful at all, so that you know what the myth and the hype around these risk-free strategies are? If this was helpful at all, do me a favor and click on like, because this way more people see the video. And oh yeah, if you want to tag Chris from Project Option, who has made this fascinating video, and he's really explaining all of the aspects here for free. Chris, great job. Anyhow. All right, that was an abrupt stop. We'll cut this out so that you have it here for yourself. Okay, cool. So I know that right now I see that there's a lot of questions here. So I want to make sure that I address the questions first, and then we can take a look at my trades. And not much has changed since Monday. So I'm still in these trades from Monday, and I also see something super odd right now on my, as you can see here on my trading view, we're just spinning like crazy. So we will see if this catches itself here in the next few minutes. And until then, we can take a look at these questions here, which I think are fantastic. Okay, good. So Marlon says, are you still coming to Vegas in March? I believe it is in February. So Money Show has invited me to come to the Traders Expo, and I believe that's in February in Las Vegas. And yes, I'll be there. If you're there at the Money Show at the Traders Expo, say hi. Would love to meet you. Would love to meet you. Okay, good. What else? Yeah, I think this was a fascinating topic, Francisco. Absolutely, because I think it was a great question, and I know that in our private community in Mighty Networks, we had a lot of discussions around this. So I thought it would be easier to answer this in the in a video here. And Wannabe Trader, isn't this a poor man's covered call? Yes, because that's pretty much what it is. It's a bull call spread, right? A bull call spread. And the main difference here is that you are lagging in, right? So there's a time difference between when you put the first leg on and the second. So for the poor man's covered call, you basically put on both at the same time. That's what you typically do. And yeah, you're absolutely right. It's like a delayed PMCC, poor man's covered call. Yeah. And MGMC, exactly. So the idea here is that you buy the first call along support, the second call at resistance. The challenge is, will the support hold, right? And I just want to jump over here to a few charts. So let's just say that you are looking at Google here, right? And you might have seen Google maybe towards September, where you say, oh yeah, Google will not go below 2600 as an example, right? And then it dipped slightly below, but it stays here in the range. So that would have worked on Google, right? Or if you're just using stocks like Amazon, maybe, right? And you see Amazon pretty volatile, but also in a range. So on Amazon, this might work as well. I said probably on Tesla. I think on Apple, I think that overall Apple is probably running higher and clipping 200 here soon. So might not make sense to be kept here. Can take a look at Microsoft, because Microsoft, as you know, has also been going up, recently trading sideways. So this were exactly what you said here. Probably buy the first call along support, sell the second as resistance. So, but this is where Kevin said that he wants to do it with a stock that he's bullish on. And you see, this is where you're saying, and what I'm also saying, it might actually make more sense on a stock that you believe is in a wide range, but rather going sideways here. Okay, good. Olava says, yeah, lots of YouTubers spreading crazy strategies to 10x your money. That's not how it works, right? I mean, of course, if you are buying an out of the money call and you're catching the right move, this could happen, but these are windfall profits. Just wanted to show you exactly how this is done. And yeah, MGMC says the performance covered call is generally entered for a debit, not a credit. That's exactly it. And the idea here is that you're creating a credit, because then it becomes risk-free. Okay. So Jörg is asking what kind of software it is. I think it's called Option Strategies or something like this. Let me just see. It is called Option Strat. So found this really cool here. And yeah, Typhoon, the risk is really when you buy the initial call and then the price tanks. Absolutely. And it would be great if it is risk-free. Once you put it on, it's risk-free. But then the question is, and that's why I wanted to do the video, why not take the profits off the table and then maybe look for another trade, right? Or why not just keep that call open and not limiting yourself? So one of the ideas could be, for example, let me just show this to you here on the software, because one of the things that you possibly could do, you see, Kevin actually was trading here. Let's go back to this. 5 Apple calls. So one of the things that you could consider is that you're only selling 2 apples, that you're doing somewhat a ratio spread here, right? Because this way you're leaving the upside a little bit open. So for 1440, we can probably do this. So the 190 call, so we add an option, we sell a call, we sell the 190, we're selling it at, this is what he said, 1440. And here we only do, let's see, we're going to a quantity of, let's say 2 or 3, right? So we could actually do this, need to unlink it so that I can do 5 here. Because what will happen is that you still have some risk, you have reduced your risk, but now you're also not capping your upside. So you can play around with this if you wanted to, but that's where it goes back to. I mean, why are you making it more complicated? And this is what I kind of feel. It almost seems like it's a little bit more complicated than it has to be, because all you're trying to do is take a quick advantage, and this is what somebody said a little bit earlier, of a move where you just buy the first call at support, sell the second as at resistance. Why would you just not buy a call here, sell the call here, buy another one here, sell it here, right? I mean, so this is why just be careful that you really understand the advantages and disadvantages of the strategies, the pros and cons, and then decide, is this really helping me, or is this just a fancy word for basically, a time delayed bull call spread? That's what it is. Okay. So Joe said I was also interested in this as well. The long dated call was risky. You see, the good news is, Joe, when you're having a long dated call, theta, the time decay is not yet kicking in. On a shorter call, if you just had a fuse of, let's say, 30 days, that's where time decay would really start kicking in, okay? So yeah, but you get it. Perfect. I see, this is why I love hanging out with you. Why do I even explain it to you? You already got this, right? You already got this. Bruno said, yeah, the premium you pay buying the call is the risk, and this is the initial risk. And you see, this is what Chris in his video also said. If you would put the bull call spread on right away, right? I mean, yes, you are paying a debit, but you're reducing it because you're selling another call right against this. So this is where you would actually reduce your risk. So there's a little bit more risk in there if you're trying to leg this in. Okay, Tulio, it's option strategist or option strat or something like this. Okay, Kapil says, can you explain a color trade to mitigate the risk? I can look into a color trade, and full transparency here. Usually what I do in Coffee with Markus, that I only show you the strategies that I personally use. But here, since Kevin asked me and others also, what do you think about this? I thought I'll show you. Full disclosure, I'm not using this strategy. I'm not planning to use this strategy because I believe that there's other things that you can do to take advantage of a sideways market here. And this is why I just wanted to share this with you. And I can take a look at a collar trade. I learned about this. I haven't traded in a long, long time. So Dave says, so the risk-free trade is really a catchy name for a poor man's covered call. Yeah, a time-delayed poor man's covered call. So, and again, this is where I think the idea is good. And what Chris here did with this video, I mean, Chris is a really great educator. He explains things really, really well. His channel has way more subscribers than me, 371,000. So this video got 31,000 views. And I believe choosing a title like How to Create Risk-Free Option Positions is a catchy title. I'm not saying that it is clickbait at all because Chris is fully transparent and explains the pros and cons. And as you can see, this is a 22-minute video here. So, but it's definitely a catchy title. You're absolutely right, Dave. Okay. So AP Blue Boy says, what happens to the call option in the expiration date that you buy and don't sell? Well, you see, this where if you have spreads like this, I would unwind them before expiration to avoid assignment, because this is when people get in trouble when they think, oh my God, I have no risk, but then they're holding it into expiration and getting assigned on one or both of these legs, right? I mean, if Apple, in this case here, where it was between 180 and 190, if it would be way above, I mean, then they cancel each other out, but it's easier to just close it on or before expiration here. Yeah. Jason, you're right. There's always some level of risk when trading. Okay. Always find it strange that men who are not poor buy poor men's covered call. Well, just a way how you can basically put up less in margin, right? So because the covered call, the covered call, the idea is that you're actually buying the stock and therefore you need to have more money. So if you want to be conscious of your buying power and you want to tie up less buying power, this is when you can do an option. But yeah, if you have a decent sized account, it might just make sense to buy the stock and sell calls against it. Okay, cool. All right. Jamie said, like this topic, fantastic. So we shall see. And that's actually, Adam, what you said, no risk, no dollars. So when trading, we have to assume risk. And I did a video on this. I'll link to it in the description where I talked about the 3 different buckets, right? Where when you're trading and you're trying to make 30 to 60%, you should also be prepared to possibly lose 30 to 60%. Then you have an investment bucket where you try to make maybe between 10 and 20%. And this is where you have less risk and you should be prepared to lose 10 to 20%. And then you have a crazy bucket where you try to make 10x your money, where you might try to turn $10,000 into $100,000, right? And in this case, be prepared if you're trying to make 100% or more. Be prepared to lose all the money. So I explained these 3 buckets in a different video. I'll link to it in the description. So Nazi says, do you do short strangles? No, I do not do short strangles, but I am looking into strangles around earnings. I looked into this in, in May 2020, and I just recently found my notes as well as was going through what I did last year, and then I looked, what did I do in 2020? And I looked at the notes and I said, you know what, that's actually a pretty good idea. So I'm revisiting the notes, and as soon as I have something to share, I will share it with you here. And Fong Wang says, can we just buy the put to protect instead of risk-free? You could buy a put, but here you see the idea is that you're selling a call, and by selling a call, you're receiving a credit, right? You could do this, but then again, this is the everlasting discussion, the age-old discussion between credit spreads or debit spreads. So Fong Wang, what you're suggesting is where you're just putting out more money. And yes, you could absolutely do this. Okay. Good. So what else do we have? My Chestnut Pilot says, new option trader, looks like all my wheel stocks will be assigned tomorrow using approximately 80% of my buying power. Is it better to roll one of the two wheels out a week to avoid using margin? If you're concerned about this, great question, because the question comes all the time, right? Should you take assignment or not? And if you really have, if you're getting close here and you said 85%, you might consider rolling one of the puts, because this way you probably drop your margin or your buying power down to 65% that is being used here. So without knowing your positions, it's really super hard to tell you what to do here. But if you're getting close to 85%, it might make sense to roll one of them and then wait until the market bounces back. And I mean, what we are seeing right now in the market is just, it's an overreaction to yesterday, the Fed. You see, the Fed basically yesterday pulled off the Band-Aid. And they said, okay, you know what? We think that employment, we got this under control. We have to tackle inflation. And I think this time, because last time it took up to 2 years to tackle this, they say, we'll do it quicker. And we do this in the next few months. And this is where, you see, previously before we saw the meeting minutes, there was a lot of speculation. What will they do? What if inflation numbers are coming in higher than expected? Well, and now we know what they do, because they already said, 3 times raising the interest rates this year. After they raise the interest rates the first time, which most probably will be in March, then they start unwinding their balance sheet. And this is where it's an initial shock that we are seeing here. And we are going right into earnings season here right now. In earnings season, you know what usually happens. I mean, we'll hear what the companies did last quarter, right? And also what guidance they're providing for 2023. And I think that we will have another great earnings season coming up, and therefore the markets will go higher. So if you look at this, we do have a blip, and still have a little bit of challenge here with my, let's just bring up the SPX, right? So where it dipped down a little bit. Right now I'm not even getting the quotes to see where we ended here. Anyhow, so yeah, but a good point. Okay. So what else? So that says for earnings, iron condors are best. Well, they work until they don't, right? So we can talk about different earning strategies. Let me prepare for this in one of the upcoming Coffee with Markus, because there's several ways how you can play this, right? You can either buy strangles or straddles if you're expecting a massive move after earnings. Or if you don't, then you can sell straddles or strangles, right? Or if you want to limit your risk here, this is where you could actually trade iron condors. Iron condors are getting really complex because you're dealing with 4 options instead of just 2. And the question is this really helpful? So we'll actually do this very similar to what we did today, that I'm just telling you the pros and cons and then giving you my take on this. How does that sound? Is that okay? Good. All right. Good. Jeez, I keep catching myself saying this, and David says your next book title should be good. Okay. So Brian says, curious why individual stocks for the wheel strategy versus, say, indices such as SPX. It's because of the implied volatility, right? The SPX has a really low implied volatility just because it is an index. Low volatility or low implied volatility means that you're getting low premium. So yes, you can do the wheel strategy on the SPX. You're probably looking more towards 10 to 12% per year if you're doing that, which, again, nothing wrong with this if you're making 1% per month. If you're doing it on individual stocks, the implied volatility is higher. When the implied volatility is higher, this means that you are automatically getting more premium, and more premium means that you are actually yeah, can make more money return on your investment. Does this make sense? Okay. So Pam says, I watched your video on identifying value stocks. Do you only trade value stocks with the wheel? That is the plan. I didn't do it last year and I got hurt, right? So this is where I think I did a coffee with Markus like 2 weeks ago. I'll link to it in the description. Lessons that I've learned from 2021 and things that I will do differently in 2022. If I would have stuck in 2021 to my rule of only trade value stocks, I wouldn't have been hurt in RIDE, for example, or also ARC-F, right? I mean, these two are not necessarily value stocks. RIDE for sure not, and ARC-F, well, debatable, but let's just say it is not. So if I would have applied that rule, and this is why I highly recommend, I mean, learn from my mistakes. I mean, when I'm making mistakes, you don't have to do this. This is why I'm being transparent here and why I'm sharing with you on YouTube what I do, the good, the bad, and the ugly. And you know about the ugly, you know about the right trade, and the other trades are looking okay. LVS is coming back, and again, right now it's really a little bit tricky with this thing here just spinning and other things flying in here that should not be flying in. But if you quickly take a look at this, so ARC-F, what are we here? No, it's ARC-F, not RF. ARC-F, right? So we'll see. Today it looks like we have kind of a reversal day. If I would use candlesticks, that would probably be a good name for the candlestick charts here. So we'll see what happens here. I'm assigned at 47.50, so this needs to go a little bit higher before I can sell calls here. What else? Boeing is a fantastic trade, assigned at 207.50. Seems that I'm getting called away there, and while I was trading, it collected a lot of premium. LVS, I told you I put on this call ratio spread. So as long as LVS finishes between 38 and 41, I'm making 300, 600, 900, or a little bit over $5,000 if it goes above 41. So we will see what happens there tomorrow. And again, usually I have this all in my watch list here. So what else? Well, RIDE is being RIDE, and it's just being, I mean, as long as they don't come out with any news, it'll just drift along there. So at some point, we'll wait for some news. And what is the other trade that I have? Oh, UNG. UNG is coming off the lows here. So this is where I'm assigned at 15.50. Already sold last week. I sold the 14.50 call here, collected some premium here. Today we got really, really close of selling the 14 or 14.50 call. Haven't been able to do this, so I'll definitely keep you posted. So I believe that these are the trades that I'm in because I promised you that I'm keeping you up to date there. Okay. So with the Fed increasing rates, markets tend to go down, right? Yeah, I mean, at least temporarily, right? I mean, overall, and I mean, this is where we can just look back at, let's see, IXIC. So even if we look at the NASDAQ and we go to a weekly chart here and we're, oops, there we go, switching it over, right? I mean, as you can see, in the long run, we always have these bumps, right? We always have bumps, and this is where we had COVID. But so here's why it's a double-edged sword, right? We're concerned when inflation is going higher, because when inflation is going higher, it means everything is getting more expensive. Companies are making less money. For us as consumers, we're not buying so more. So we got to get inflation under control, right? How do you do this? By raising interest rates. Now, when raising interest rates, it doesn't mean that all stocks are being hurt. So if you go back here and look, for example, at stocks like banks, Goldman Sachs, yay, did well. Bank of America, yay, did well here today, right? I mean, actually, this is a weekly chart. Let's go to a daily chart. You see over the past few days, they did really well. Wells Fargo, right? So there are always some stocks, but this is where we kind of see the rotation going on. And the rotation is out of these growth stocks back into value stocks. So this is why Caterpillar, I mean, one of the most boring companies probably to trade, because look at this, right? I mean, just in a narrow range here. But this is a value stock that got a boost here. Let's see, probably Walmart. Let's see, Warren Buffett's favorite, KO, Coca-Cola. Look at this, Warren Buffett's favorite here, going up as a value company. So this is where Olavo, some of the stocks will be hurt in the short run. In the long run, will people still buy growth stocks? Of course, because this is where the greed kicks in, right? And yeah, Brian, whether I know we talked about SPX or SPY or QQQ or diamonds for the wheel, right? Just you got to lower your expectation in terms of RI here. Okay. Good, good, good. Do they really exist? Who is they? We never know. We never know, right? Okay, Adam is asking, great question. Do you like the VIX at a certain level when you make an options trade? No, in general, if you look at the VIX here, which is the volatility index, right, or also the fear gauge, typically the higher the VIX, right, the more fear you have in the market and the more premium you have in options. But this is where you see who asked the question here, Adam. That's why I like to look at individual stocks, right? Because individual stocks, they all have implied volatility. And there are some stocks who have an implied volatility of only 30. Then there's some stocks who have an implied volatility of 40 to 60, which I think is a sweet spot for the wheel, right? And then when you have stocks that have implied volatility of 80 and above, it's usually aggressive plays here. So we can talk about implied volatility in one of the upcoming videos that I can show you exactly. And again, for the wheel strategy, Adam, since you asked here, instead of looking at the VIX, look at the implied volatility of the stocks that you're interested in. And so a sweet spot is usually between 40 and 60. It's not a hard rule. I will take a trade when the implied volatility is at 38, and I might take a trade when it is at 65, but just as a rule of thumb here. Okay, is this helpful here at all? Good. All right. So, oh my gosh, we are already 45 minutes in. Hey, was this helpful today at all? If it was helpful, do me a favor and click on like. Feel free to share this video with anybody who might want to hear about risk-free trades. And I also have some videos popping up here. Take a look at these videos or the link, the videos in the link in the description. And then I will see you in one of the next videos. Have a great rest of your day, and I'll talk to you soon.